we're going to do a little exercise first. Tax brain teaser, okay? All right, so on our tax brain teaser here, we're looking at the example of Bill. Bill is retired and he has taxable income of $41,825. And he is in, as we can see there, the 22% marginal tax bracket. He also has $38,000 in IRA income and $25,000 in Social Security benefits. So Bill decides that now that he's retired, he's 65 years old, he's taking the standard deduction, that he's going to take a road trip and go see his hero, Paul McCartney, in concert. Did anybody go to the Paul McCartney concert here in May, by the way? Anybody? No. Nobody? Really? Wow. It was fantastic, by the way. And it would be worth paying $1,000 for. So Bill taps his IRA for $1,000 to go pay for this concert road trip. So the teaser question here is, how much will he owe in taxes on that $1,000 that he took out of his IRA? Well, remember, Bill is in the, 22% tax bracket, right? So it would stand to reason that if Bill's in the 22% tax bracket, he would pay how much on $1,000? $220, right? Well, take a guess. Wrong. So actually, Bill is going to owe $407 in taxes on that income. Okay, I see a couple of puzzled faces. That's good. So this teaser is kind of a good way to set the stage for the theme of what I'm going to be talking about today, because what I'm really going to be going through is, as the title says, how tax planning changes through the 4 stages of retirement, and specifically how people can miss very important aspects of the tax code if you don't pay close enough attention. So, by way of introduction here, my name is Matt Murphy, Certified Financial Planner. I am the new guy here at CFP, or at CFG. Get those two mixed up sometimes. Full disclosure. I'm not new to the industry. I've been in this business for 22 years. I've known Joe and Aaron and the folks here for a long time, but just got the courage up to join them here recently. So you all are my first in-person audience for a workshop. So I have to tell you, this has been in the works for a while. I'm super excited. I had a lot of coffee this morning. I've been up since 4:15 this morning. So if I get a little jazzed, forgive me for that, okay? Couple of housekeeping items, and this is probably different. It's definitely different than if you've been to a CFG workshop before, that I don't want you to be alarmed about. There's a camera in the back, okay? That camera is not designed to capture anything about you. If you're on the run, you're in the witness protection plan, we're not going to tell on you. The reason we have that is, and this is a good thing, we've had overwhelming replies to this workshop in particular, and a lot of them recently. And so, in fact, I'll tell you, you all are privileged to be here today because we had a waiting list of attendees. Yeah, so what we're going to start doing is, at least when I'm doing them, we're going to record these sessions so that the folks that weren't able to make it can go online and can watch later on. So, as we're going through, I'll talk about how I'm going to handle questions, but as we're going through, the only circumstance where your voice or maybe even your face could possibly be caught on camera would be if you ask a question. Now, that's not to discourage you from asking questions. As long as you look at me and you don't look back there, your face won't be on the camera. So I think we're going to have some fun going through this. You all have taken, to a certain extent, a risk coming in to see me this morning. I am going to take a risk with you as well, and I'm going to buck the kind of conventional wisdom that says that in a complex presentation like this, you shouldn't take questions along the way. After much careful consideration, I decided that I will. However, I reserve the right to punt or defer on any questions if either I don't know the answer, and I'll tell you if I don't, or number 2, if it's truly something that's too complex or personal to somebody's situation to really address in the group format here, You'll have an opportunity in the packets that you have to give us some feedback, and also you can write questions down, either to answer later on, or if you work with one of the planners here at the office, jot something down and say, hey, Matt mentioned this in the workshop, are we doing this, or, should I look at this? Or if you don't work with one of the planners here, you can certainly schedule that with me as well. A couple more housekeeping items, and then we're going to dive in and have some fun. So everybody should have a packet here. There is a feedback form inside of that packet right here on the left-hand side. Candidly, like if you're working with an existing planner, it's asking you for a lot of information here. We have your address, we have your email, we have your phone number. Don't worry about that. We do need, though, from each attendee, from a compliance standpoint, or each household, let's say, we do need this completed at the end to record your attendance here today. Okay? But also there's a couple of lines in there. If you have questions or feedback on the workshop that you'd like to provide, or if you'd just simply like to say, make sure that guy never gives another presentation, that's okay too. On the left-hand side, also behind that, you will have if I can get it out, a really nice piece actually on the Guide to Taxes in Retirement. We're going to cover most of the stuff that's in here today, but there's some really good kind of detailed stuff that's in there for you to take home as well. And then most of the stuff on the right-hand side, you'll see my little bio here if you want to read up on me, and then also a piece on CFG as a whole. Okay, so let's jump in. Well, we're going to kind of tiptoe in. I should put out there that, and we're going to talk about this, there's a difference between tax preparation and tax planning. What we're going to talk about today is tax planning. Tax preparation requires a CPA or a tax professional, right? We have CPAs here, but we don't provide tax advice, and that typically pertains to tax preparation, doing your tax forms, consulting on whether you're eligible to make this IRA contribution or that one. And so, just from a full disclosure standpoint, just know that this presentation is not designed to give you tax advice, but we are definitely going to consult with you on some tax planning ideas. Now, I'm not going to poll the audience here to see who's in retirement or who's about to retire and so forth. We're not going to get that personal. However, suffice it to say that taxes in retirement are a lot like your investments in retirement. And really what I mean is transitioning from pre-retirement to retirement. You think about how your money should be invested in retirement versus how it should be invested pre-retirement is different, right? In retirement, normally you're looking to get some income, drawing from your accounts, you have minimum distributions and so forth. Well, that same paradigm applies with taxes. So think about all the things now, if you're in pre-retirement, think about all the things you have from a tax standpoint that are benefits. So if you're still working at a company, you have 401ks you're contributing to, you're saving on taxes that way. You maybe have a mortgage, you get some interest deductions there. If you have kids, you have the child tax credit. Most of that stuff goes away in retirement. And people don't think about that. They don't think about the things that will change from a tax perspective in retirement. And specifically, you have Social Security, Medicare, and required minimum distributions to deal with. And we're going to touch on all those things today and some really important stuff for you to watch out for. And let me say this presentation, whether you're not retired yet, or you're already retired, or you've been retired for 10 years, or 20 years, or whatever, there's meat on the bone in this presentation for everybody. Okay, so there may be some things that apply more to others than you, but there will be something I can assure you're going to walk away with today that you'll say, oh, that was pretty cool. Okay, so what's the first thing that we need to understand about retirement and taxes? You have to know what your after-tax retirement savings picture looks like before retiring. You're saying, well, Matt, I already retired. It's too late for that. Okay, so that's one of those examples, right? So if you have $500,000 in your 401k, it's not really $500,000. Why? Taxes. Who owns a portion of that, really? Uncle Sam, right? So as it says there, if you're married filing jointly, that $500,000, really, and this is an extreme example, if you just took it all out of the 401k at once in a lump sum, at the 35% tax rate, really it's $325,000 instead of $500,000. So the government's got a ongoing vested interest in your 401k. And obviously, in addition to that, you'll be required to take a required minimum distribution. Morning. That's okay. The only penalty for that is you have to sit in the front, unfortunately, folks, but welcome. So you also have to take, obviously, required a minimum distribution, and there's some traps and some tricks to look out for there as well. So this is kind of neat here. If you look at cumulative after-tax distributions, so what this is illustrating to you here is if you had that $500,000 retirement account and it earns 6%, so before let me preempt any questions, not suggesting this is a specific investment that earns 6%. This is just a hypothetical, right? So if it earns 6%, look at the impact of a 33% tax rate versus a 12% tax rate versus a 0% tax rate in terms of what your cumulative distributions are. So, somebody that has a 33% tax rate over the span of, 25 years ends up taking out just over $600,000. So we started with 500, it earned 6%, but we paid 33% taxes on it. We were able to take out $600,000. Well, if our tax rate was 12% instead of 33, we took out about $850. And if our tax rate was 0, then we took out closer to $1 million. So the whole purpose of that is to just illustrate the premise that to the extent that we can, we want to try and manage our tax exposure throughout retirement and minimize the amount of taxes that we pay, which, by the way, sometimes may mean paying taxes more today so that you have to pay less later on. All right, but at least I'll still have Social Security to supplement my income and Medicare to pay my health costs. All right, folks. Make sure your seatbelts are securely fastened. We're about to get into the fun stuff now. Okay, Social Security, as I mentioned, have their own tax traps, and you need to plan for them as well. So Social Security and taxes. Remember our buddy Bill, he's going to see Paul, paying $1,000 to do it. I told you I think it's worth it. So remember we said that on that $1,000 that Bill took out, it wasn't a $220 tax bill. It actually ended up being a $407 tax bill. So the before concert trip and after concert trip, the difference in those two at the top is just that Bill took out, so this is kind of a layout of his mini tax form here. Bill took out $1,000 from his IRA. That's the only thing he did differently. Social Security was the same, everything else was the same. He just took $1,000 out to go take his trip. Notice, however, the difference once we go from IRA income to Social Security benefits to AGI. What's AGI stand for? Adjusted gross income. Okay, what happened there? Did his adjusted gross income just go up by the $1,000 that he took out of his IRA? No, it didn't. It's interesting. And now look at his taxable income. His taxable income also went up by more than $1,000, even though all he took out was $1,000 from that IRA. Very interesting. Now, I'll do the math for you. We've done the math for you. The increase in his AGI and taxable income is $1,850. Took $1,000 out of the IRA, but the AGI and taxable went up by $1,850. Okay? So think of it this way. For every dollar of income, for every dollar Bill took out of his IRA, he paid taxes on $1,850. Now, I think Paul's worth $1,000, $1,850, debatable. All right? How does that happen? Well, we have an increase in the income tax of the $407. Okay? So if we look at the tax brackets there, Bill is still in the 22% tax bracket, right? Because he only took $1,000 out, and I think his income was the taxable income's right there, right? So you look at the taxable income brackets for 22, and it says 41,776 to 89,075. So by taking that $1,000 out, he hasn't come anywhere close to going into another tax bracket, right? But he's paying this 40.7% tax on the difference there. Anybody want, this is when I'll open it up to questions. Anybody want to ponder a guess as to why that is? And there's no dumb answers. I'd love it if somebody, if somebody thinks they have a dumb answer, I will protect you from everybody else if you answer it, I promise you.
Social Security taxes went up.
Uh-huh.
Medicare.
We're getting to that next. Good one. So, man, we could spend 2 hours on this alone. Social Security, so remember, we're talking about a single taxpayer here, right? Bill's a single taxpayer. Social Security has a calculation that it performs to determine how much of your Social Security income is taxable. I'm not going to bore you with all the details on that. I'll give you the basics, which is they start with what they call Social Security modified adjusted gross income, right? This is why we have all these new IRS agents, by the way. You've got to keep track of all this stuff and make up some of this new stuff too. Social Security modified adjusted gross income, which is your adjusted gross income adding back some other items, like if you have tax-free municipal bond income. So believe it or not, that gets added to your adjusted gross income when determining how much of that is your Social Security is taxable. Now, I get this question a lot. So I have a Roth IRA and I'm taking money out of that. That's tax-free like a municipal bond. So does that mean that that counts too? No, it does not. So a Roth IRA does not go towards your Social Security modified adjusted gross income. Only, well, not only, but from a tax-free income standpoint, municipal bond income does. Okay? Another common one that I see, well, I don't know about common, but one that may come up would be like student loan interest gets added back to. You know, by that time, normally people don't have student loans anymore, but you never know. And there's a number of other things that are kind of like foreign income tax paid. Like there's a number of other items that get added back, but they're kind of obscure. So, but my point there is they develop whatever you come up with whatever your Social Security modified adjusted gross income is. Then you determine what your provisional income is. I mean, geez, is this like, I mean, it's like on and on and on. Provisional income is your Social Security modified adjusted gross income plus half of your Social Security. I know, not, it's like where do they come up with this stuff?
Say that one more time.
Okay. Provisional income is your Social Security modified adjusted gross income plus half of your Social Security. If you're married filing jointly, it's just what it sounds like. Like, you know, half of like if my wife and I are getting $30,000 in Social Security, half of that would count towards this provisional income. Now, once you get to that number, then, and some of you may have seen this before, there's the $32,000 and $44,000 threshold. Some people are familiar with that, some people aren't. They call that the base amount and the adjusted base amount, right? Where that provisional income falls with regards to those amounts is what determines how much of your Social Security is taxable. If it's and it's also dependent upon whether you're single filer or married filing jointly. So if you fall under the $32,000, none of your Social Security is taxable. If you fall between 32 and 44, up to 50% of it is taxable. And if you fall, or if you go over 44,000, up to 85% of it is taxable. Now,
From $1. From $1.
from $1. It's not, very good point. It's not tiered, although Yeah, see, this is what I could go down the rabbit hole for, I keep you guys here. I'm gonna get hungry by noon, so I'm not gonna keep you here that long. You could go down the rabbit hole on this. There are circumstances where it can be. So, but just in general, what you said is correct. So in Bill's example, what happened was he took $1,000 out, and think about his Social Security income kind of just hanging out over here. He takes the $1,000 out. By doing that, it pulled some of his Social Security income that wasn't taxed before or was being taxed at 50, and it taxed it at 85. So you tell me, is Bill really only paying 22% taxes? Is he paying 41%? No, he's paying 41% tax. Absolutely. Absolutely. There was a question.
Yes, thank you. And if you're going to hit this later, tell me to be
Okay.
quiet. Where does interest, dividends, and capital gains fit it? Does this have any?
Mm-hmm. Yeah, that's a good question. That goes into your AGI.
It does. I thought
Yep.
so, but I wasn't sure.
Yep, it's a good question. Yeah, so that would feed, before we even got to this, that would have fed into the AGI. Yes, ma'am.
Can you review the thresholds again? The
Yes.
42?
32, and I'm glad you brought that up because I have another point to make on that. 32,000 under that, not taxed. 32 to 44, 50% taxed. 44 and above, 85% taxed. With the stipulation that up to, and that's too detailed to get into today, and probably even is more of a specific tax advice question, but those are the thresholds. And this is my point, give me just a sec. That came out in 1983. You know how many times it's been adjusted for inflation? Take a guess. Zero. In, what's that, 40 years? In 40 years, those numbers, so each and every year that goes by, it's capturing more and more income that's tax-free. Okay. Yes,
So
sir.
your tax rate on the 33,000, because you're over 32, would be at 12%. Is that correct?
Say that again?
Your tax rate at 33,000 for my Social Security would be taxed at the 12%, because that's the income tax rate.
Bingo. You got it. Exactly. Exactly. All right. In the interest of time, we got to close the chapter on this. We're going to move on. Okay? Pretty neat though, isn't it? I mean, it's one of those things where it's like if you didn't know that, and Joe and I talked about this on the radio show, I don't know, maybe 2 or 3 weeks ago, if anybody listened. And I told him, I said, we need to talk about that before the end of the year. Why? Because what happens at the end of the year? We're buying Christmas presents, we're buying holiday gifts, we're taking trips. And I cannot tell you how many times over the years I've seen clients inadvertently do what Bill just did. And then they come back to, oh, my tax bill was way higher, last year. Yeah, well, you got torpedoed by Social Security. So, okay, Medicare. So we've got the example now. We've moved from Bill to George and Martha. George and Martha are retired. They have Medicare Parts B and D. They're a high-income couple, $283,000 of modified adjusted gross income in 2020. Remember, we're present day 2022, so that's 2 years ago. That's significant. We'll come back to that. They bought a stock years ago, and they sold it for a $1,000 capital gain. Now, in general, what's the capital gains tax rate? In general? 15. 15, correct. Now, in general, there's exceptions to that for sure. But in this case, we're just using the basic 15%. That $38, the extra 3.8% would kick in for taxpayers married filing jointly over $250,000. There's a net investment income tax, I think that came out about 10 years ago, something like that, of 3.8% on all investment income, capital gains included. All right, so really, they, on their $1,000 gain, they're going to pay about $188 in taxes or an 18.8% tax rate. I mean, you know the punchline here, right? So it's just 18.8% taxes, right? No, wrong. So they are running into Irma. Has anybody familiar with Irma? You guys seen that before? Another one of these acronyms that somebody probably got paid $1 million to come up with. See if I can get it right. Income-related monthly adjustment amount. You don't need to know that, but what it basically says is, and you guys have probably seen this if you're on Medicare, which is that the basic premise is the higher your income, the more you're paying for Medicare, right? But it's a tiered system. And it's also a cliff. So we call this the Medicare or the IRMA cliff. You know, we had the Social Security tax torpedo, now we have the Medicare IRMA cliff. And what the cliff says is, if you go $1 over the income threshold, like you get really, you know what? You know whatted. Thank you, Maddie. Slammed, okay? But it's a cliff because unlike the normal income tax brackets before, where, you know, with your income, if you have $50,000 of income, like some of it's not taxed, and then like the next $10,000 is taxed at 12, and then only the dollars above that next threshold get taxed at the higher rate, right? It's only those dollars. So that's a tiered. With this, once you get over the ledge, so to speak, it's all penalized. With a very good, thank you. With the 2-year look back. So that was the significance of when I said we'd come back to that with the 2020. So they look back, Medicare looks back, or Social Security really, looks back 2 years at your income to determine whether this applies or not. So like this really requires, you know, I mean, you might have forgotten what you did 2 years ago, right, from an income standpoint. So it really requires some care and attention. So in their case, what they did is they were at, let's go back for a second, they were at what, 283.5, but now now remember when you take a capital gain, even though you don't think of it as income, it is. So they bumped up into that next Medicare threshold above the 284, and what did it do? Well, it increased their premiums. This thing, I tried this thing's not going to do well, so I'll just have to tell you. It moved their Medicare premiums up about $100 each, right, per month each, okay? And it also took up their Medicare Part D premiums in the same fashion, right? So about $19 each per month, call it $40 a month, right? So that their total first-year charges for this $1,000 capital gain that they took, that they probably thought, you know, innocently, but oh, we're going to sell this stock, cost them $3,000.
Not including the $183 that they paid in the taxes.
We're getting there. You guys may have come late, but you're sharp. Okay. So, $1,000, sold it for a $1,000 gain, technically paid $188 of capital gains tax plus that 3.8%. Stock sale triggers the IRMA, and IRMA surcharge is $29.16. We add that to the 188 and we get 3104. So as bad as Bill's situation was with a 41% tax, George and Martha, 310% real tax rate. Yikes.
We should have taken out $10,000.
Yeah, I mean, why not, right?
Right.
Or, you know, I'd be going to see my doctor every week at that rate. I mean, just, you know, get your money's worth. All right, closing the chapter on that one. It's yeah, that's why we got to have a little fun with it. Good point. That is depressing. However, the whole point of me even doing this presentation is you don't have to deal with any of this stuff. I mean, some stuff may be inevitable. Maybe you had to sell that stock, and maybe that's the only thing you could have done to raise $1,000 of cash, right? Like That could be the case, in which case you just got to deal with the consequences here. But in almost all of these circumstances, good planning avoids all this stuff. Yes, sir.
So, am I hearing that your investments, money you make on investments increases your Medicare premiums?
It can. It can. So, okay, so let's go back. That's a good point. Let's assume for a minute. Now remember, George and Martha, 283.5 in, I'm sick of using the acronym, let's just call it their income, okay? 283,500 of their income. The next threshold for Medicare starts at 284,001. So, if instead of it having been a $1,000 gain, if let's say it was a $200 gain, right? Well, they still, now their income would be 283.7, they still would have been in this bracket and their Medicare wouldn't have gone up. Right? Their Medicare wouldn't have gone up. So to answer your question, yes, capital gains can increase your Medicare premium, but only to the extent that you weren't careful enough to see whether taking that gain was going to push you into this next bracket.
So that's your job as a planner to make sure that you stay where you need to be.
You know, unless, and this comes up, unless you know, you've got some account out there at Robinhood that you're day trading, you said, Matt, look at me, I made $1,000 on this one, you know? And I'm saying, yeah, Jim, well, guess what? You're going to pay $310,000 or 310% in taxes on that. How smart are you looking now, Jim? Which I wouldn't do it that way. Pardon me?
Do any of your clients go rogue?
No way. Are you going to go rogue? So, you know, and again, the moral of the story here is we're trying to build awareness of this first and foremost. If you're aware of this, you're much less likely to fall susceptible to it, obviously. But for those of you that are working with a planner here at CFG, you know, this will help you become a better informed client too, so that you can go to Joe or you can go to Gary or whoever and say, you know, hey, I was looking at this and Matt had mentioned this thing about Medicare. You know, are we good there? I was thinking about taking some money out or whatever. Is this going to, you know, foul up my Medicare or Social Security situation? And they, by the way, they all know this stuff. I'm just presenting the material. They all know this stuff as well. So yeah, I mean, that is our job to help make sure that you avoid those situations for sure. Okay. Here's another good one. This one's not, well, I was going to say this one's not quite as punitive, but it can be. So now so we had Bill, then we had George and Martha, now we're doing Jim and Ann. Jim and Ann are 68. Jim retired at 65, and Ann retired 1 year later at 66. So she retired at 66. They get coverage through Ann's employer, who offers retiree health insurance. So when should they enroll in Medicare Part B is the question. Well, for those of you, if anybody has enrolled in Social Security, and correct me if I'm wrong here, but if anybody's enrolled in Social Security prior to age 65, then by the time 65 rolls around, you're automatically enrolled into Medicare. Am I right?
Part A.
Part A, yes. Right? Okay. So in this situation, Jim is retired. Ann is still working past 65. So the question is, does Ann need to enroll for Medicare as soon as she turns 65?
Not if it's credited.
She doesn't. That's right. That's right. If it's creditable coverage, that's correct. She doesn't. But when does she need to? Bingo. That's right.
Yeah.
Literally the second she retires.
It's got to be rolled over immediately.
Yes, immediately. So what this is illustrating here is that, and we're picking on all these poor people, Bill and Jim and Ed and George and Martha, you know, but what we're illustrating here is that they didn't do that. And this is a common thing too. I haven't seen this very often, but it's a good point to bring up. you know, it's like, oh, well, I'm covered through my company and they have retiree health coverage. So I'll get around to it when I get around to it. Yeah, well, if you do that and you miss the enrollment for Medicare, the missed enrollment penalty, as it says there, is 10% of the base premium, not for a year, not for 5 years, for life. So just the base premium. So the base premium, as we saw in George and Martha's example, $170. So their penalty is, and that's monthly, so their penalty is going to be $17 times 12, $204. But it's not just for Ann, it's for Jim too. So that's $400 for the couple. And what happens to Medicare premiums every year? Do they ever go down? Are they ever going to go down?
Will they not go down if your income reduces?
Good question. The base premium will not. I mean, I say will not. I mean, I suppose it's possible at some point in the future the base premium could go down. It ain't going to happen. But remember what we looked at on the previous slides was the IRMA. That's the extra tiers. Yeah. So yes, in theory, you could get into one of those extra tiers and then your Medicare premiums reduce because you're no longer in those. Yeah, exactly. Yep. So if the premiums tend to increase every year, it's not a set dollar amount every month that you're paying. It's a percentage. So obviously, as a percentage or as the amount increases, the percent is the same, the amount goes up. So I didn't show the math there, but you know, that could translate if you kind of extrapolate that out, $408 a year. Extrapolate that out over a lifetime or over retirement, could be a $10,000 mistake. Yes, sir.
What happens if one of you is still working, the other one has not gone on Social Security yet, but is in Medicare Plan A, and the other partner is on full medical coverage through their work, and the spouse is also on like doctor care, not hospitalization, but doctor care? When do they have to be enrolled in Part B?
That's one I'm going to punt on. That's a good question. I'd have to research that. I'm not sure. Has anybody been in that situation?
I'm in that now.
Are you? What's
I mean,
the?
I'm working and my husband's automatically on the A, and so he's covered under my insurance until.
So he's on until you
It's just
retire.
paying a free one.
Yeah.
He's running, you know, it's showing us the secondary to our health insurance.
That's what I'm doing.
Got it.
I'm on.
Okay.
I did
Okay.
that too, and I just had to get a letter from my employer stating I was continuing.
That it was covered. Yes.
And then-
Yeah. Yes. So the other thing, and some of you may have run into this too. The other thing that's key to keep in mind here is usually the enrollment period is like, what is it, January 1st to March 31st or something like that, and then the coverage becomes effective July 1st. So like you really got to kind of pay attention, you know, and make sure that you don't miss that window to enroll in the coverage, because of course, as we can see here, that can be really expensive.
And him being on the Part A doesn't affect my HSA. I checked into that. because
Oh, that's a good one too.
I'm purposely staying on to plunk away the money in the HSA.
So, okay, man, I'm glad you brought that up.
Glad you did too.
Yes,
And then I invested so it could pay my premiums for the rest of my life.
very good, very good. So on the subject of HSA, and I should have covered this before because, you know, sometimes the question comes up of, well, you know, if I've already gone over the limits for the IRMA thing, we're jumping back a little bit now, is there anything I can do about it? And not really. However, in a circumstance where married filing jointly and one spouse, so if you're on Medicare, that means you're 65, that means you're ineligible to make an HSA contribution. However, you may have a spouse that is not on Medicare, that is not 65, that could be, if they're part of a high deductible health plan and have an HSA, could be eligible to make an HSA contribution, which is an above the line deduction, which reduces AGI, which could avoid the George and Martha situation. So specialized situation there, obviously, but something maybe just to keep in the back of your mind there. Okay. Are there other tax traps we'll face? Yes, there are. All right. I think we're humming along pretty well here. You must plan how and when you will use taxable, tax-deferred, and tax-free assets to manage your income and tax brackets efficiently. Probably, other than healthcare, when I'm talking to clients that are about to retire, this is probably like the other most frequent question I get, which is, all right, Matt, I've got, I've got retirement accounts, I have non-retirement accounts, I have Roth and regular IRA and 401k. And which one do I draw from first, right? So that, again, that could merit an entire 2-hour discussion of how to handle that stuff. So what I did is I just put in one idea or thought on that. This is not going to apply to everybody, but there's so many different strategies for that again, it would just be, I just sort of cherry picked one that could make some sense for folks. And if that's a concern or question of yours, you need to sit down with your planner and talk through it. Or if you don't have a planner, come talk to me about it. Roth conversions, okay? This is a pretty straightforward thing, but there's lots of misconceptions about it. Number one, a Roth conversion is simply taking money from a pre-tax bucket of money. So let's think, what are pre-tax buckets of money? 401ks, traditional IRAs, rollover IRAs. Taking that and moving it over to a Roth IRA. So a Roth IRA, what's the main benefit of a Roth IRA? Grows tax-free, and then when you take it out, it's what? Tax-free, right? Assuming you follow like the different provisions, 5 years and all that other stuff. So that can be really beneficial. There is no limit on how much income you make, on how much you can do in a Roth conversion, on how old you are. We had a guy calling in the radio show. Did anybody listen to the radio show this morning by chance? Yeah? Did you hear the guy, Lloyd, in Orlando that was like 93? Just sharp as a, 95, I think, actually. Or no, maybe 93. Sharp as a whip, man. It was impressive. But Lloyd, from Orlando, if he wanted to, at his ripe old age of 93, could convert to a Roth IRA. Even if Lloyd had no income, Lloyd could convert to a Roth IRA. Now that's different. The reason I'm bringing that up is that's different than, somebody contributing to a Roth IRA. Okay? Contributing to a Roth IRA requires earned income. So, like and the contributing part is the 7,000 this year, 7,500. 7,500, the Roth IRA contribution limit. In order for you to do that, you have to have, first of all, your income has to be below a certain threshold, right? Around, depending on your filing status, 180 to 200,000. It's got to be below that. In order for you to even be eligible to do that, to make that contribution, okay? But that's putting new money into a Roth. A conversion has no such stipulation. So anybody can do a conversion to Roth at any time. Well, why might you do that, and how does that impact, or how does that play into our discussion today? Well, remember earlier I said there's a difference between tax prep and tax planning. Tax prep is looking at what already happened and trying to make the best of it. Tax planning is trying to pay the least amount of taxes in the future, or in the long term, let's say, but sometimes may actually call for paying more taxes now. This is a great example of that. Now, why would you want to pay, hypothetically, why might you want to pay more taxes today than later?
You make more now.
You make more now, that's one.
Or Congress will raise the tax.
Congress raises taxes later on, that's another. There's one more that some people don't think about very often. There's one more reason why you might want to do it now.
Avoid you from falling off the cliff or increasing your adjusted income to get you in a different tax bracket.
God, I love the way you're thinking. He's even using the terminology, the cliff. Yeah. Hold that. I'm going to come back to exactly that. That's a great thought there. Another might be that, you might have an interest in leaving money to kids, grandkids, beneficiaries, et cetera. And let's say that you've got, I don't know, let's say you're retired and you're in a low tax bracket, low relatively speaking, and you've got some really successful kids, grandkids, maybe they're whatever, high income earners. If you leave them your IRAs, then they got to take it out in 10 years, very good. And think about it, like, I'm 44, so if my parents passed away and I inherited their IRAs, and if I was making a ton of money from age 44 to 54, that's like the absolute worst time that I would want to be inheriting this money and being forced to take money out every year and pay taxes on it, right? That'd be terrible. I mean, terrible. That sounds really bad. It wouldn't be terrible. It'd be great, right? But in the world of taxes, that would be terrible, okay? So one way around that, and again, this requires that, this is for somebody that really is already taking care of their own needs, their own situation, but is really interested in, maximizing the amount they're going to leave to their kids, is doing a Roth conversion now. You pay the taxes at today's lower rate so that your kids, grandkids, et cetera, later on, can take it out tax-free. Now, inherited Roth IRAs, by the way, like the regular IRAs, still have that 10-year requirement. You have to take it out within 10 years. However, it's not taxed.
I have a question.
Sure.
So perhaps an opportune time for this, if you're both still working and like plan to work to 70, so it might not be a good time with the tax brackets of both of you working. Could you capture that with the new RMDs at 72? Could you capture that window between 70 and 72 to do that? Yep. Or, yeah, I mean, that's a... Because you would just have Social Security.
Exactly.
No forced RMDs.
Exactly, yeah. Now, if you did that, you'd have to keep an eye on the Social Security tax torpedo,
Yeah.
right? And your Medicare thing and all that stuff, right? So, but yeah, I mean, where I've used that most, frequently is with people that have significant IRA balances, pre-tax, balances, retire at 60, don't really need the income right away. Maybe they have other sources of income or, whatever the case may be, and they've got a 3, 5, 7, 10-year time horizon where they can chip away at that each year and take $20,000, $30,000, $50,000 per year and convert it over to a Roth. Man, that can make a lot of sense. That can save you tons of money. So, yes, Manny.
So, you have an IRA, and you have a rollover IRA. So you can take some out of anything you want at any amount.
Any amount, any of those, as long as it's a pre-tax retirement account, like an IRA would be. Yep. Yeah. Yes, sir.
If you're working, you can contribute,
Yep.
because you're already taxed, that income's on your paycheck. But you can actually put more money from savings or other vehicles into the Roth. So if we wanted to put 40,000 instead of 15,000 in, we still need to see what our tax bracket is to make sure we don't go over.
Exactly.
Okay.
Exactly. Yeah. And exactly. And so actually, the next slide will illustrate that a little bit. Because so in our example here, now we have Jill. Jill's converting 100,000 from her IRA to a Roth. She'll have to add 100,000 to her income. The conversion income will be taxed at her rate. So we know all that. So, pardon me. The strategy here is kind of filling up the bucket. So what this is illustrating is pre-conversion. Jill's already filled up the 10, 12% brackets. So let's put this into real world practice. Let's just use married filing jointly. Married filing jointly, 12% tax bracket goes up to about $83,000 for 2022. Okay? So, and then 83 to 171 or something like that is 22. So in this case, what we're saying is that maybe she's got 50,000 of income. So at 50,000, she's filled up the 10 and the 12% buckets already. and she's put a little bit, actually I'm messing my numbers up, aren't I? So, yeah, not a good example. The point here, turn the recording off while I'm doing this. The example here is if she had a sum of money, say $30,000, between where her income is now and where the next tax bracket threshold starts, then it might be advisable to fill that bucket up. That's the difference right there, right?
Yeah.
Just under what the next threshold would be. So I shouldn't have put it to numbers, but I did. So, but I think, did everybody see that example? Okay, despite my stumbling through it. So that helps in a number of ways. It helps it can help, again, if you do this early on, it can help prevent you from having massive minimum required distributions, later on. And maybe tax rates are higher later on than they are today. So that may end up really not working well in your favor. But it can also, let me say this. One thing to keep in mind there is you may want to wait till the end of the year to do this, right? And why might you want to wait till the end of the year to do this?
See where you're at.
See where all your income is, exactly. Yes, sir?
If you're doing a conversion and you do 50 grand in the conversion, if it puts you just over into the next bracket, you're only gonna pay taxes on the amount that goes into that next tax bracket. So 10 of the 50,000 gets you into 32%, you're only gonna pay tax on that.
Great point. Yeah.
Unless you go over the cliff.
No, that-
I'm done here. You guys, you got it. You got it. That's exactly right, and so is that. That's exactly right. So to your point, yeah, you don't have to stress it too much. If you bump over by, and the gentleman's point is well taken, which is, all right, I'm going to try a number example again, okay? So let's say the next bracket threshold is $100,000, and you convert an amount such that, it's 102. Your income for the year is 102,000. You're only going to be taxed at that higher rate on the $2,000 overage. Not that big of a deal. To the lady's point, what might that do? It might give you the Social Security tax torpedo, and it might really mess up your Medicare premiums because you might fall off the IRMA cliff.
The tax bracket.
Nope.
Medicare, that would be too simple.
Well, of course. Well, then we might not need the 87,008. Well, Yes, ma'am.
If you're already getting an RMD, can you take some of the money from the RMD and put it into a Roth?
Great question. And you guys are seriously asking like really good questions. No, you cannot. That's a very common question that comes up. So the question was, can I take my RMD and convert that to a Roth IRA? And it seems logical that you should be able to do that. It seems logical that the tax brackets ought to match up, right? But they don't, and it doesn't. So if my RMD for this year is $20,000, that $20,000 has to be taken, it has to be paid taxes on, some exceptions which we'll get to, and it cannot end up in a Roth IRA. Now, having said that, I could then take more money out and do a Roth conversion. So I could take $30,000 out. If my RMD is 20, I could take 30 out, and I could treat 20 as my RMD, and then I could take the other 10 and do a Roth conversion with that.
Any overage of what?
Yeah, as long as, once you've satisfied the minimum, you can pretty much do whatever you want from
Could you
there.
buy tax-free muni bonds?
Yeah, sure. Just remember, the income from those, anybody remember? Where's it go? Social Security, modified adjusted gross income. All right. I'm going to keep this one a little simple because we still got a decent amount of ground to cover. Other possible approaches to managing tax brackets: withdrawing tax-free money from life insurance policies. I'm not going to get too in-depth on that. However, I run into clients all the time that have these old whole life policies that they bought 50 years ago. They're like, well, should I just cancel this thing? I haven't even had to pay premiums on it for 25 years. Those can be a source of, the cash value in there can be a source of supplemental retirement income. And if you play your cards right, you can draw a good chunk of that out tax-free. So just know, for today's purposes, just know that that is an option. Okay. Selling highly appreciated stock for no capital gains. And you're like, well, how would you do that? Thought you had to pay capital gains, right? If you fall in the if you fall in the 10% or 12% income tax bracket, your long-term capital gains tax rate is what? 0. Exactly. Pardon me?
Under 100,000? Isn't there some?
No, just if your income, if your tax bracket, if your income is such that you fall in the 10% or the 12%, so going back to my example, if you're married filing jointly, that would be roughly $83,000 of taxable income. After deductions too, by the way. So like after all the deductions, if it's less than $83,000, then you are in the 10 or 12% income tax bracket. Long-term capital gains would be 0. Now here's the trick to that. However, of course, there's always a trick or a trap. That income or those capital gains count towards what? Income. Okay, so where that works is if your taxable income without taking any gains is $50,000. You're married filing jointly. We know that the next bracket starts at $83,000. So if it's $50,000, you could take roughly up to about $33,000 of capital gains and not have to pay any taxes on it. Long-term capital gains, meaning you held that investment for more than a year. So, can be a good way to, especially if you've had like a stock that, I don't know, you bought a long time ago, you inherited a long time ago, you want to raise a little bit of cash. Go in and sell it if you're in that tax bracket situation. Sell it, probably get out scot-free without paying any taxes.
If you draw money from a insurance annuity, so that money you take out, you don't have to pay taxes on it?
You do, so good question. If it's not held inside of an IRA, then the annuity would have a basis, meaning it would have a certain amount of money that you've already paid taxes on, and then it would have a certain amount that's counted as gain that you've made. You would have to take, not in all, but in most circumstances, you'd have to take the gain out first, and you have to pay taxes on that as income. There are some exceptions to that. That's probably a afterwards kind of question, but in general, the answer would be yes, you'd have to pay taxes on that income when it comes out.
Because if it's listed there as a monthly draw, off that insurance policy, then that's taxable.
Yeah. But it could be that some of it is and some of it isn't, depending on the annuity and your basis and everything else.
Isn't the basis with insurance like that the premiums you paid in? Say you had $100,000 in cash out on a life insurance policy and you paid $50,000 in premium, you only pay $50,000 on the gain.
Yes, except
Okay.
every time I say that now, there's like 5 people giggling, right? It's like, because that's the way it is.
Tax on everything else, yeah.
Dividends reduce your basis in a life insurance policy. So yes, but. Okay, taking distributions from IRAs or 401ks to take advantage of a lower rate. We kind of talked about that before. If you're one of those people that retired at 60, you don't need income until 70, it can make sense to not keep deferring all that tax deferred stuff and maybe start taking it now and paying the taxes now rather than continuing to defer. Okay, I'm going to kind of skip over this one a little bit, but 2 other pre-retirement strategies. Really the main one is what I mentioned before about the HSA thing. And then the QBI, Qualified Business Income, that is there's like 10 pages on that. We're going to skip that one for now. If anybody has any questions on that, let me know. Okay, charitable giving and tax planning. So now we're moving on to Albert and Shirley. So Albert and Shirley are some very nice folks. They want to give some money away to charity, $5,000 as a matter of fact. They're in the 24% income tax bracket. They have 15,000 of itemized deductions currently. 2022 standard is 28.7. So if they make a $5,000 donation, what we're going to see here is there's no federal tax benefit doing that. But what they could do instead is, what were the names? Albert and Shirley. So what they could do instead is Albert and Shirley could do what's called a qualified charitable distribution. And I'm sure some of you, maybe many of you are familiar with that. And what the QCD, qualified charitable distribution, allows you to do is donate money from your IRA directly to a charity. Now, why would you do that? Well, especially as it says there, you don't get a deduction for doing so. There's no income tax deduction for doing that. But it does count towards your RMD. Yeah. Let's go to the example. It'll be easier for me. Okay. So let's contrast it with not doing it that way. A non-QCD contribution. So here's what the non-QCD contribution looks like. And man, I see this a lot too. The beginning of the year, client takes out their minimum required distribution. And the money maybe sits in the checking account for a while. And then at the end of the year, we're doing some tax planning, and it's like, well, I forgot to give the church this, or I forgot to give so-and-so that. Well, I'm just going to write them a check. Okay, so we're going to write XYZ charity a check for $5,000. Now, what's the problem with that? It wasn't correct. The problem with that, before QCDs, there's nothing wrong with that. It was fine. The problem with that is the $5,000, yes, it satisfies the RMD. It's reported as taxable income. So if we're in the 24% tax bracket like these folks are, they're going to pay $1,200 on that. So really the cost of that contribution was $6,200. With the QCD, the money, so going back to that example, in January, or maybe we just wait until December or November or whatever, the $5,000 literally is picked up out of the account and it's dropped into XYZ church, charity, whatever, 501c3. That doesn't even hit your tax bill, or your tax, what am I looking for? Your tax return. That doesn't even hit your tax return. Okay? So think about doing it the non-QCD way is kind of like you're taking the money out, you're paying taxes on it, you're writing the check to the charity, and you're what? You're hoping that you get a deduction for making that charitable contribution. And you're hoping for it because if your itemized deductions are not sufficient to be large enough to be over the standard deduction, which I think we saw was what, 28.7? So in these folks' case, it was 15,000 was their itemized deductions. They gave 5, so now they only have 20. They got no tax benefit for doing that. No tax. In fact, it hurt them because they had to pay the $1,200 in taxes to get the money out of the IRA, right? Now, the reason this has become really popular in the last several years is what happened to the standard deduction a few years ago? Went way up, right? So now, in order to qualify to itemize your deductions, you've got to have a lot more stuff, right? You got to either have a mortgage, or you got to give a ton of money away, or whatever the case may be. So there's a lot of people that are unknowingly being generous, but hurting themselves in the process. It's good to be generous, but I mean, we might as well take care of ourselves while we're at it too. So the QCD, 5,000 goes directly to the charity. Charity doesn't care. They get the same amount of money, right? They still get the 5,000. It's $5,000 to them either way. But really then, the cost of that was just what you gave them, right? It was just the $5,000. It didn't cost you anything extra from a tax perspective to make that contribution. And so, like I said earlier on when I said, well, you don't get a tax deduction for doing this, that's true because tax deductions only go towards reducing income, right? Well, this doesn't even go on as income. That $5,000 never hits your radar from an income perspective. So any questions on that, the qualified charitable distribution? Okay, I will tell you, when clients come to me and the question is, for those that, and remind me, I need to talk about who's eligible for this. Almost forgot that. When somebody who is eligible, that I know is eligible, comes to me and says, what's the best way for me to save on taxes? By far, this is the immediate first thing that I tell them. The first thing. Because number one, this is the easiest thing. And number two, this is where most people make a mistake. So who's eligible? All right, we get to pick on the IRS a little bit again here, all right? What's the required minimum distribution age now? 72. What did it used to be?
7.5.
How old do you have to be to do a qualified charitable distribution?
7.5. But is it right?
It's right.
Good, okay.
It's right.
I wasn't sure, that was gonna be my next question.
70 and a half. 70 and a half.
Why? Yeah, why? They just didn't catch it.
They just didn't catch it.
Yeah, they
That army of agents that's out there scraping through every little aspect of the code, and they just kind of missed that one, huh? So anyways, it's true. 70 and a half. Now, here's the other thing. 70 and a half. So when the 70 and a half used to apply to required minimum distributions, you were eligible to take your required minimum distribution at any time in the year in which you turned 70 and a half. So if you turned 70 and a half in December of a year, if that year in January you took your distribution, you're good to go. With the QCD, guess what? You actually have to be 70 and a half. Like you have to wait until the day that you are officially 70 and a half to do the qualified charitable
What
distribution.
about leap years?
That's another one that probably just slipped through somewhere. I mean, this stuff, I'm telling you, I don't know where they come up with some of this. It is crazy. You're also limited to $100,000, but that's per person. So if you're married, you can each do $100,000. If you're otherwise eligible, you can each do up to $100,000. All right, we good on QCDs?
On inheritance
Yes, sir.
money that you do have to draw every year, there's an RMD every year.
Yes, and man, that's a really good point.
I inherited some money from my mom, which passed away, and every year I have to draw before the end of the year.
You sure do. And you can do, all right, since I'm on the record here, I better get this right. You can do a conversion with inherited IRA money, a Roth convert, but you cannot do a QCD from inherited IRA money. So thank you for bringing that to my attention. Yes, ma'am. Yep.
You inherit X amount of dollars, you're not a spouse, you have to do it in 10 years, but you don't have to do it the first year, you just, so by the end of the 10 years, you take it, isn't that correct?
Oof, you're getting into some murky waters here. So the IRS, I was just a couple weeks ago, I was just on like one of these webinars with somebody that's super knowledgeable on that, like on these subjects, and he said that it's still up in the air as to how that will be handled.
Article in the, what you call it, magazine, that addressed that, and that's what they said.
I think, yeah, I think that's true, but it's like, it's one of those things where they just changed the tax code, they just threw it out there, and, there was hundreds of things that nobody even thought through before they released it, so, yeah. All right. Last kind of chapter here, okay? Hope to have assets passed on to my family. How does retirement tax planning figure in? So in other words, let's think about legacy. We talked about estate planning on the radio show this morning. This is following up to that. Organize your assets for your family's benefit. Estate planning still matters. People think estate planning, they're like, oh, well, I don't have an estate tax problem, so I don't need to do estate planning. Well, that's totally not true. Okay, we're going to talk, again, there's a whole bunch of stuff in this. I kind of like I did with the Roth conversion thing, I kind of just picked out this piece on long-term care because I'm going to illustrate something that I think you'll find interesting as it pertains to this here. But you think about leaving money behind, what's one of the biggest impediments that can prevent you from leaving money behind to beneficiaries would be, you get into a long-term care situation, right? So, so premiums can be deductible at federal and state level. There's some limitations on that. Payments from policies for reimbursement of long-term care expenses are tax-free. That's one of the benefits of having if you have long-term care insurance, of having that. And then, of course, choosing how to pay for long-term, and this is what we're going to get into, how to pay for long-term care costs can have a big impact on your heirs. All right, Florence. So Florence is, she qualifies for long-term care benefits, and you've probably heard it's like if you can't perform 2 of the 6 daily activities of daily living, then you qualify. So she gets in-home care benefits of $60,000 a year. She has $20,000 in Social Security. She has $400,000 in an IRA. And then she has a a life insurance policy that has a long-term care rider of $500,000 that goes to her children upon her death. So that's the life insurance piece. And the reason we have this in here is because we see these all the time. It's not a commentary on whether they're good or bad. They can be both. Or that policy will provide up to $10,000 a month for her for long-term care costs. Have you guys heard of or seen stuff like that before?
Yeah,
Okay.
I have
Okay. Yeah, I know you do. All right, so scenario 1. So when you buy that policy, why are you buying that policy? If it's and I'm not picking on you, Maddie, but just in general, if you buy that policy, it's life insurance, but it's got a long-term care feature to it, what's the motivation behind that? Why are you doing that? For your kids, right? Yeah.
I don't have to live with anybody else.
Yep. Okay, you guys are, that's probably reason enough. Yeah, for all those reasons, right? For you're buying that policy for long-term care. Otherwise, you would have just bought a regular life insurance policy, right? Okay. So point being, what I'm going to illustrate to you is sometimes the worst thing you could use that thing for is long-term care. Yeah, sometimes. Not always, sometimes. So consider this. If you have a lot of medical expenses, what can you do with those medical expenses from a tax perspective? Deduct them. Anybody remember how the threshold works there? So it has to be in excess. Your medical expenses, if they're over 7.5% of your what? Your AGI, yep, then they're deductible, okay? So think about this situation where she was paying, by the way, long-term care expenses are medical expenses. They are. She's paying, what do we say, $60,000 per year? $60,000 per year, I think, something like that, okay? So she's gonna have a lot of what? Medical expenses. And because she has a lot of medical expenses, she's gonna have a lot of what? Tax deductions, okay? So, as it says here, Florence pays little to no income tax during the last 5 years, the years where she's receiving this care. I guess it was at home. She's receiving this care. So in this case, she's going to use her long-term care policy to pay for the 5 years of care. So her long-term care insurance pays the $300,000 for the in-home care, $60,000 a year times 5, right? Tax-free, it's a good deal. And the kids will inherit, remember the policy was $500,000. So the way those things work is whatever's left over goes as a tax-free death benefit to your beneficiaries. So it's good. Kids inherit tax-free life insurance of $200,000 as well as $400,000 of her IRA, which is taxable. Okay, that's how this is how most people do it, for what it's worth. What do you think we're going to do with scenario 2? Man, I shouldn't have switched it so quickly like that. No, that's good. Although those, you guys are thinking the right way, because if we have all these tax benefits, So that's another thing too. If you're in a year or a couple of years, we're gonna have a bunch of tax benefits, that's a great time to be converting to, or tax deductions, great time to be converted to Roth IRA. What she's gonna do instead now,
She was paying some donations.
yeah, she's gonna have all these deductions in those last 5 years anyways.
Right.
So she's gonna use her IRA to pay for the care. And why is she gonna do that? She's gonna do, you see it? Yep, the light bulbs go on. So she's gonna do that because she's gonna get the same amount of money. I mean, roughly, could be a couple bucks here and there, depending on what the tax deductions actually add up to be and so forth. But now instead of the kids inheriting the 400,000 IRA,
You're gonna get
Pl-
600,000.
that's it. Yeah,
And the life insurance is,
tax-free. So they're gonna get 600,000 tax-free versus 200 tax-free and 400 taxable.
Unless she lives another 15 years.
Now, to be fair, it's a good point. It's a good point.
then the IRA is gone.
The kids are like, Mom, how you doing? How's it going? Remember that little strategy we put in place? How's that coming along? So, and again, that's a good point. All of these examples are intended to exactly what just happened with the light bulb to go on, right? So that you're thinking beyond, I don't know, maybe what conventional wisdom is. Conventional wisdom tells you buy long-term care so that you use it for what? Long-term care. And, probably in a lot of cases that makes sense. But there's some circumstances where, man, that's gonna cost you thousands of dollars if you do it that way.
Very interesting.
So, goodness, how in the world are we ever gonna manage all this? Right? So, all right, let's recap a little bit. My goal was to get everybody out of here by noon, and doggone it, it's 11:48. My wife and kids know that I get hangry. And it's 11:50. I'm not feeling it yet because we're having a good time and we're rolling.
There's food back there.
I know there is. Yes. And you guys, by the way, you guys have been fantastic. Literally one of the best audiences that I've ever had. Super participation. Everybody's following along. All right, let's recap a little bit. Tax and retirement highlights. So, of course, pre-retirement, we talked about know your after-tax savings before retiring. That was the, that graph where I showed of, the cumulative after-tax amounts. Just illustrating the point that you need to try and manage your taxes over time. So for early retirement, understanding Social Security and Medicare taxation, filling the brackets in the low-income years. So the Social Security was the tax torpedo. That was Bill at the 41%. Because he pulled in some of his other income that was not subject to, Social Security income that wasn't subject to taxes before and made it taxable. The Medicare taxation, we talked about that. That's the IRMA stuff. It's a cliff. And then filling in the tax brackets in low income years. So that was some of the Roth conversion stuff. Managing your planned RMDs, qualified charitable distributions are a great way to do that. And even Roth conversions, as we said, could be. And then, of course, late in retirement, organizing things so that you have tax efficiency in your estate planning. And, just going back to that example, just to be clear, I mean, what I wasn't illustrating there, and I want to be real clear about this, what I wasn't illustrating there was that, you're eating cat food for dinner so that the kids get to live high on the hog, right? I would never advocate for that. No way. I mean, unless it's my parents, but, No, I'm kidding. I mean, you need to take care of you and you first. I mean, in fact, that's probably the best way to take care of your kids anyway. So that's really an efficiency strategy for everybody, right? That works better for all parties involved. So, all right, so this is kind of like a nice, solution summary page. I covered all this stuff already. So, and all of this stuff too. Questions? Yes, sir.
You've got stock portfolio funds. Some of your stocks did very well, some of them didn't do so well, actually lost money. When can you take out the funds that have lost money, and can you deduct the loss from your income?
Good question. So, I talked about that on the radio show a couple weeks ago too. And to me, that's turning the proverbial lemons into lemonade. So, you know, it's like in a year like this, the market's down whatever it's down so far. And I don't care who you are, like everybody's feeling that pain, right? Unless you've literally been sitting on the sidelines. So that being the case, if you have losses in your portfolio and it's not a retirement account, you know, like it's a taxable, a brokerage account or something like that, you can use those losses in two ways. Number one, you can use up to $3,000 of those losses to offset your income, tax deduction, all right? And you can use that in perpetuity. That never expires. So if you took $100,000 of losses this year, what's the math? For the next 33 years, you could take a $3,000 deduction on your taxes. However, having said that, it would first be applied to your capital gains that you had in that year. And that capital gains, so if you had $50,000 in capital gains that year and you had $100,000 in capital losses, it would first be applied to the capital gains. It would wipe those out. And then that extra $50,000 would carry forward, and each year would be used to offset capital gains that you have. And whatever wasn't used for that would do what? Offset the income up to $3,000. And that also never expires.
Cool.
So that's a good question. Yes, sir.
Since the IRS changed the rule about stretch IRAs, where your kids inherit it, they gotta do it within 10 years, does that also include a Roth IRA, since they wouldn't pay the taxes on anything withdrawn from it?
I know. Yes, it does. Yes, it does. It does, and it kind of seems a little counterintuitive because of that, because you think the motivation behind the government forcing that 10-year out is that they're going to get tax revenue, right? They still kind of are, though, when you think about it, because what they're doing is they're getting your money out of a tax-free realm sooner by forcing the 10. So the question was, you know, I inherit a Roth IRA. Do I still have to take it out in 10 years, even though it's a tax-free situation? The answer is yes, you do.
It doesn't count as taxable income?
No, nope, but you just got to take it out. You got to show that you did it.
Okay.
All right, I got to show this one too. Anybody want to read that for me? I don't want to read it either. But thank you. I really, really, really appreciate not only everybody's attendance today, but I really appreciate everybody's participation. You guys have been fantastic. I think we had a little fun here too.